Hello everyone, welcome to Achievers Academy. So we are continuing our video series where we are discussing about previous year question of economics, that is of UPSC prelims economics questions of 2020, 20 and 2019. Okay, so earlier in one video we have discussed few questions of economics. Right now in this video we'll see and solve the rest of the questions of economics that came in 2019 and 2020. Okay, so as you know all these things that we are not only solving the questions, we are analyzing the questions and solving the question with some logical reasoning by answer elimination techniques or by applying some kind of logic. Okay, so that approach we have to inculcate to correct as much as answer possible in our exam. Okay, so let us begin. Okay, you can see the question 98 number that came in 2020 prelims. They are asking, in the context of the Indian economy, non-financial debt includes which of the following? Okay, statement 1, housing loans owed by households, amounts outstanding on credit cards, and option statement 3, that is your treasury bills. Okay, so first thing you have to know about non-financial debt. What is non-financial debt? If you even know what is financial debt, then you can easily solve this question. Like, financial debts are those debts which were taken by one institution or one organization to re-lend it. Okay, suppose say NABARD. Okay, NABARD is taking some kind of debt from other banks and re-lending that money in the market. So the money which were used in the purpose of re-lending, that we'll call as financial debt, and those money or those financial parts which are not included in re-lending, that will consider as financial debt, non-financial debt. Okay, so those which are used as re-lending, that will tell as financial debt. Okay, those debts which are used in re-lending, that will call as financial debt, and those debts which never used in re-lending, we'll call them as non-financial debt. So as you can see in these three statements, all the three statements are regarding non-financial debts. Okay, here the money or the debt they are taking, they are not re-lending that money again. Okay, as housing loans, you are taking the housing loans not to re-lend that loan. Okay, or the credit card amount that you are having is not to re-lend that money, or you can say about treasury bills also the same thing. So all the three statements are non-financial debt. So in the context of Indian economy, non-financial debt includes all these three things. Okay, housing loans owed by households, amounts outstanding on credit cards, and treasury bills. So the option would be D, 1, 2, 3. With reference to this 97 number question that also came in 2020, they are asking, with reference to Indian economy, consider the following statements. Commercial paper is short-term unsecured promissory note. Certificate of deposit is a long-term instrument issued by Reserve Bank of India to a corporation. Call money is a short-term finance used for interbank transactions. The fourth statement is zero coupon bonds. The zero coupon bonds are the interest-bearing short-term bonds issued by the scheduled commercial banks to corporations. Okay, so here, if you know this fact, that what is the difference between short-term money and long-term money, that is your money market and your your financial market. Okay, so in this financial market, you have one long-term money or your short-term money. So always this long-term financial instruments are like bonds, shares, all these things. Okay, those which are used for a long term or long time period. So like your bonds. So bonds have some maturity period. Before that, you cannot get the money. Okay. So again, I'm repeating, your short term or your long term financial instruments are generally bonds, and short term instruments are your commercial papers or deposits, these things. If you know this facts only, if you know this fact only, then you can easily eliminate the option. Okay. Let us read the option again. Commercial paper is a short term unsecured promissory note. Yes, this is correct. Second statement, they are saying certificate of deposit is a long term instrument. I told you this deposits or these papers and all these things are generally short term. Okay, they are not long term. So option 2 is statement 2 is incorrect. Third statement, they are saying call money is a short term finance used for interbank transaction. Yes, this is again correct. And the fourth statement, they are saying zero coupon bonds. Here the statement come bonds are the interest bearing short term bonds. Okay, they are not short term bonds issued by scheduled commercial bank to corporations. Okay, generally these bonds they don't have any interest. Okay, government will repay the money with some after the maturity of the bond. So they are not like interest bearing short term bonds. This statement is also incorrect. So if you eliminate statement 2 and statement 4, the correct answer would be option A, that is 1 and 2 only. Okay. So let us discuss about this financial market in bit detail. Okay. So see here, financial market is of two types, your capital market and money market. So generally capital market is long-term market, means that is more than 1 year. The maturity period will be more than 1 year for the financial transactions that are happening in this financial capital market will be of long term, that is more than 1 year. Okay. And in money market, it is of short term, that is for less than 1 year. Okay. Share market, stock market, share bonds, government securities, sovereign bonds, all these things are coming under your financial market. Okay, remember this fact only that whichever bonds or whichever financial instruments which are used for more than 1 year or the maturity period is of more than 1 year, that is of long term, that will consider as capital markets. Okay. But see these things, bills, notes, treasury bills, cash management bills, promissory notes, commercial papers, all these things are coming under your money market. Okay. So money market, first treasury bills. So what are these treasury bills? These treasury bills are the bills or the papers which are lended by your bank and borrowed by your government. Okay. So bank will lend this treasury bill and government will borrow this treasury bills. Okay. Hello everyone. Welcome to Achievers Academy. Today we are going to discuss about economics previous year question from UPSC 2019 and 2020. Okay. So I hope you have already seen the video of this series where we are discussing about previous year question. I've already made the video regarding this economics previous year questions. Okay. In last video, we discussed about some 10-15 questions, and this is the continuation of this last lecture. If you have not seen that video, so please watch that video. So let us start. I'm sorry. Hello everyone, welcome to ACHEVERS Academy. In this video lecture, we'll discuss about economics previous year question from your UPSC 2019 and 2020. This is the continuation of the video lecture where we are discussing about previous year questions. So I have already made one video of your economics previous year question discussion. If you have not seen this video till now, please watch that video. Here we'll try to solve the question by using some elimination techniques. Generally, those are based on your logical reasonings. Okay. And not only that, we'll discuss the question in detail. The first question, that is question number 98 in this book, they are asking, and this question came in 2020. In the context of Indian economy, non-financial debt includes which of the following? Okay. So generally, if you know about financial debt, that is financial debts are those debts which are borrowed by financial institution to re-lend those money. Okay. Suppose say NABARD. Okay. NABARD is borrowing money from RBI and re-lending those borrowed money in your economic markets or financial markets. So that those monies will call as financial debt. And non-financial debts are those debts or those monies which we never use for re-lending, like your housing loans owed by households, amounts of outstanding on credit cards, and your treasury bills. All these things, all the money that we generate from these debts, will never re-lend those monies. So we'll consider them as non-financial debts. So that means your option D is correct. That is statement 1, 2, and 3 are correct. Next question. Which of the, with reference to Indian economy, consider the following statements. Statement 1, commercial paper is a short-term unsecured promissory note. Certificate of deposit is a long-term instrument issued by the RBI to corporation. Call money is a short-term finance used for interbank transactions. The fourth statement is zero coupon bonds are the interest-bearing short-term bonds issued by scheduled commercial bank. Okay. So here also you can solve the question with bare minimum idea that what is the difference between your capital market and money market. Okay, both are coming under your financial markets. So one is your capital market, that is long-term market, and the money market, which is your short-term market. Okay, generally the bonds or the shares, those which have maturity period more than 1 year, we'll consider them as long-term instruments, and those instruments which have maturity period less than 1 year, or the transactions that are happening in less than 1 year, we'll call them as short-term market. And the instruments we are using, such as your bills, papers, those things are generally your short-term instruments, like your commercial paper, certificate of deposit, call money, etc. Okay, so here this, if you see this statement 2, they're saying that certificate of deposit is a long-term instrument. No, it is a short-term instrument. Okay, and zero coupon bonds, interest-bearing short-term bonds. This is also wrong. So option, if you eliminate option statement 2 and 4, the only option left is your option number C, that is 1 and 3 correct. Okay, so let us discuss about this financial market in bit detail. As you can see here, the financial market is divided into two types, that is your capital market and your money market. Capital market, here the transactions or the maturity period is more than 1 year, but in your money market it is for short term, that is less than 1 year. So generally the share markets or the stock markets, okay, they are coming under your financial market, coming under your capital market, and the instruments are G6 bonds. Okay, so remember this fact that wherever you will see these bonds and securities, they will come under your capital market. Okay, they have maturity more than 1 year. And what about this money market? This is short-term market. Okay, generally it includes bills, notes, treasury bills, cash management bills, and your promissory notes and commercial papers. Okay. So see this table here. We have shown this fact about different bills and bonds. Okay. First, treasury bill. It is a kind of your short-term financial market where government issues this treasury bill to borrow money from your bank. So here the lender, that means the money lender, is the bank and the borrower is the government. Okay. And the interest rate that government has to pay is determined by your market. Okay. Similarly, in the call money, the transaction is happening between the banks. Okay. So one bank will lend the money and one bank will get the money by issuing your call money. Okay. So generally it is short-term market, and the interest rate is determined by your market. Okay. And another concept attached to it is interbank offer rate. Okay. Interbank offer rate means if one bank borrows money from another bank, okay, then the second bank will lend or will take some kind of interest from the first bank. So if both the banks will start giving some kind of offer or will decrease the interest rate, then it is not good for your economy. If IBOR increases, that means the economy is heading towards one crisis. Okay. Next thing, certificate of deposit. In certificate of deposit, bank is the borrower. That means bank will lend this certificate of deposit to get money from public. Okay. So it is also market determined, the interest rate. Next is your commercial paper. In commercial paper, the corporate will issue this commercial paper to get the money from your public. So in this case, public is your lender and borrower is your corporate. And in this commercial paper, the borrower and the lender is both corporate. Okay. Next question. What is the importance of term interest coverage ratio? Okay. Even if you know the fact or the concept of interest coverage ratio, you can easily solve this question. Okay. See this thing, that interest coverage ratio is a debt or profitability ratio used to determine how easily a firm can pay or cover interest on its outstanding debt. Okay. That means it is kind of your company's past record. Okay. If the company has a good past record to pay the interest rate in on time, then that means that company has the capacity to pay the outstanding debt. Okay. That means interest coverage ratio is nothing but the ratio between the profit and interest to be paid. Okay. If this thing is good, if the interest coverage ratio is good or it is increased, then the company has the capacity to repay the debt. Okay. Because their profit is increasing. Okay. In comparison to your interest to be paid. So in this case, the company can easily pay the debt. So in this question, let us solve the question with this bare minimum idea. So they are saying that it helps in understanding the present risk of a firm that a bank is going to give a loan. Okay, this is also genuine. Okay, the statement is also very generalistic. That means it is correct. It helps in evaluating emerging risk of a firm that a bank is going to give a loan to. Yes, both these things are correct. On the basis of your interest coverage ratio, the bank will decide, or the bank can calculate the risk to give debt to your company. Okay. So on that basis, they can say whether they can decide whether to give loan to the industry or the firm or not. Okay. So for this reason, statement 1 and 2 are correct. And look at the statement 3. Here they are saying the higher a borrowing firm's level of interest coverage ratio, the worse is its ability to service its debt. This is wrong. Okay. That we have discussed. That means if your interest coverage ratio is increasing, then the possibility to repay the debt is also increasing. That means this statement is incorrect. That means if you are eliminating this uh, third statement, then you can easily get the answer 1 and 2. That is A, 1 and 2 only correct. Okay. Next question. Here also you can solve the question with bare minimum idea. Okay. Let us see. Here they are asking the Reserve Bank of India recent directives relating to your storage of payment system data, popularly known as data dictates, command the payment system providers that statement 1, they shall ensure that entire data relating to payment system operated by them are stored only in India. Second statement, they are telling they shall ensure that the systems are owned and operated by public sector enterprises. Third statement, they shall submit the consolidated system audit report to the Controller and Auditor General of India by the end of calendar year. Okay. So here, if you see this extreme word, that is only if you are like solving the question based on this reasoning that extreme words are always incorrect, then here you can trap. Okay, here the statement 1 is correct, but statement 2 and 3 are incorrect. Okay, generally if you know this thing that RBI is not audited by your CAG, then you can easily solve the question. Perhaps maybe you can reach the 50-50 situation where you can eliminate the option C and option D. You have to choose between option A and B. Okay, so the correct option would be option number 1. Okay. And if you read this statement 2 properly, they are saying that they shall ensure that the system are owned and operated by public sector enterprises. This is something like very vague. Why only public sector enterprises will consolidate this thing? Anyone can. Private sector also can consolidate that thing. Government cannot mention this thing that only public sector will do this thing. This will increase the burden of public sector. So you can eliminate the statement 2 also. Okay. But let us discuss this thing in bit detail. RBI, in its directive on storage of payment system data, has made it clear that entire payment data shall be stored in located only in India. Okay, so those data regarding your payment will be stored in India only. All system providers need to ensure that within a period of 6 months, the entire data relating to payment system operated by them is stored in a system only in India. Okay, so they are saying that it will store in India, not only by the public sector units. Okay, private also can participate in this thing. Data stored in India should include end-to-end transaction details, information about payment transaction. The data could be pertaining to customer data like your name, mobile number, Aadhaar card, and PAN number. Payment sensitive data like customer and beneficiary account details. Your payment credentials like OTP and PIN number. Transaction data such as originating and destination system information amount. Okay, and CAG will not audit this thing. CRT will audit this thing. Okay. So with this fact, we can reach to the answer that statement 1 is only correct. Here see, consider the following statements. Petroleum and Natural Gas Regulatory Board, that is PNGRB, is the first regulatory body set up under Government of India. One of the tasks of PNGRB is to ensure competitive markets for gas. Appeals against decision of PNGRB go before Appellate Tribunal of Electricity. Okay, if you see this statement, that statement number 1, they are saying that PNGRB is the first regulatory body. Okay, which is something very vague. Okay, which you cannot digest easily. That why Government of India like initially will make one PN gas or natural gas company as regulatory. They'll not regulate this thing initially. They have other demands. When the country got independence, after that they have some other demands. Okay, they will not regulate all these things initially. They have to regulate different other issues. So government will never regulate this thing at first. Okay, even if that situation is there, then you must have heard this thing before, but this statement is incorrect. So if you eliminate this statement number 1, then you can easily get the answer, that is 2 and 3 are correct. The chairman of public sector banks are selected by generally your bank board bureau. Okay, remember this fact, bank board bureau will select your chairman. Okay. Look at the question number 91 that came in 2019. They are asking which of the following is not included in the assets of the commercial bank in India. Okay. So remember this fact that asset of a bank always is the money of the bank. Okay. Whatever money the bank is lending or whatever the money bank is giving, the money of the bank is the asset. And the source of that money, if coming from outside, then we'll consider as the liabilities. Like in this situation, advances, investment, and money at call and short notice, they are lended by your bank to some other institution or some other individual. They will get back the money with some interest. But see the deposits. Deposits are not the money of bank. They are deposited by your customers or individuals. Okay, so these are the liabilities of your bank. They have to return the deposit with some interest after some time. So that's why deposits are not the assets of the bank. Question number 92. In the context of India, which of the following factor is or are contributor to reducing the risk of a currency crisis? Okay, if some currency crisis is happening, then which will contribute to reduce that risk? First statement, the foreign currency earnings of India's IT sector, increasing the government expenditure, remittances from India abroad. Okay. Okay. If some currency crisis is there, that means the value of rupee is going down. So in what situation this will be managed? Okay. How to strengthen this rupee? Okay. One thing is that if you are borrowing from outside or some dollar currency is coming in India in higher quantity, then the value of rupee will also go high. So in this, from this three situation, two situations are regarding your like inflowing of your dollar from outside or foreign currency from outside to India. So if the number of foreign currency will increase, then it will also increase the value of your money. Okay, Indian currency, that is your Indian money, Indian currency, Indian notes. So in this three, from this three statement 1 and 3 are telling the inflow of money from outside, but statement 2 is not telling about this thing. So if you eliminate this statement 2, then you can easily get the answer, that is 1 and 3 are correct. Okay, these things are the balance sheet of commercial bank. These are liability and assets. Liabilities are the source of funds. Okay, if the source of fund is outside, like your checkable deposits, your non-transaction deposits, borrowings of the bank, they are the sources of funds. Okay, fund is coming from outside, so that's why they are liabilities. And the assets are uses of funds. Okay, like your cash items, reserves, bond cases, securities, loans, all these things are your assets. Okay. So that's it. Thank you for watching the video. If you like the video, then please hit the like button and subscribe to our channel to get more videos like this. Okay. And one more thing, we are providing the course for your OPSC and UPSC, as well as for your other state PCS, SSC, and other exams where they are asking questions from GS. Okay. And along with that, we are providing English, mathematics, and reasoning courses. Okay. In your UPSC, OPSC, we are preparing it in combined. Okay, we'll prepare both mains as well as in your prelims days. So the interested candidates, please contact on this. Okay. So thank you for watching the video. If you was till now, then please hit the like button and subscribe to our channel to get more videos like this. Thank you.